Are you a trader? Are you a gambler? There's a fundamental difference. Your money is on the line. So when you put on a trade, do you have a gambler mentality where you're only thinking profits, but you're not thinking how to safeguard just in case the market goes against you? Or are you a trader where you execute a plan? You have a take profit target, as well as an exit strategy. We're going to look at that today with options. As always, I like to teach by doing. I actually do these trades with options, and then I will show you the trades as a lesson nugget, right? This is also great for me too to journal to document uh, what's been going on in my head, why I put on the trade, and to walk you through it. And hopefully, you can learn by example, by real life practice examples that I'm showing you right now. Today, I had put on a sell on a put option to generate cash. I love generating weekly cash. Now it seems to be every day I find great stocks. And one of the stock is NVDL. This is a two times leveraged NVIDIA. NVIDIA's going down these days. There's a lot of news now. Trump agreed to allow China to buy NVIDIA chips, the high-end chips. But the stock's been going down anyway. And as the stock goes down, it's a good buying opportunity for me to get extra premium, right? So NVIDIA, I believe was NVIDIA L was 87 when I had put this trade, and I sold at the 80 strike price, which means if the price goes below 80, then I can hold on to NVIDIA at $80. I will buy it at $80. In the meanwhile, I'm waiting and they paid me $51. It's called $51. You can see that I put on other trades as well, similar put options. Now, risk management should always be on a trader's mind as opposed to a gambler. A gambler just thinks, I'm going to buy it and I'm going to double my money, triple my money. But what happens if the trade goes down? It goes against you. What do you do? Right? You have to plan, have that contingency plan in case it goes opposite of what you expected. You can see here that I put this trade December 12th, 80 strike price, and sold it at 51. I'm going to show you how exactly I put the trade and how a true trader will limit loss in case the trade goes against. I'm going to walk you through on the trading screen here. I'm trading options. And when I open the trade, this is exactly how I did it. NVDL. I select NVDL and I would do a sell to open. And let's do one contract. And it's a put option that I sold. And I had sold it for December 12th, which is a weekly option. And I picked $80 for the strike. All right. It was 87.50-ish when I sold it. And if it goes below 80, then I buy it at 80. So you can already see that I would save myself over $700, right? So that's $700 downside protection, which is already a great start. And then I put a limit price of 50 cents, for example. And they would pay me out $50 minus there's a little bit of options trading commission. And then when I executed this order, which you saw on the previous screen, it did execute. I got paid out $50. So currently I have a put option out there. It's short. I had sold it and collected $50. Now, a trader, okay, so at this point, a gambler would just say, good, I'm just going to not worry about anything after that. A trader, on the other hand, is going to do exactly this. Go back to the screen after having sold one put option, and same thing, you put in NVDL. Before we did a sell to open, this time on that position that you're currently holding, you're going to select buy to close. Everything is opposite. Sell to open, now it's sell to buy. We're going from sell to buy and then from open to close. So you're going to buy back what you opened previously. And in this case, everything's the same. December 12th, 80 strike price. And we're going to change the limit order. And the limit order is very simple. Whatever premium you got paid, multiply it by 2. That is my exit strategy. Can't get any simpler than that. All right. So what happens is if the trade goes against me, it goes down and down, and I don't want to own the shares. This is key point. If I want to own the shares forever, I don't mind owning it forever for long-term investment, then I'm not going to put this uh, stop loss, right? I want to buy the stock at a lower price and keep forever. And that's a long-term investment strategy, which I highly recommend for short-term traders. And let me clarify, generally 80% of my money is for long-term investing. So if it's long-term investing, I don't touch it. 20% is for trading to generate cash flow week after week. And this is exactly what I'm talking about now. When you're trading for the short term, and you're just targeting weekly cash flow, you want to preserve your capital. You want to maintain your principal. And to do that, you want to put stop losses. And I would put a stop loss at twice the premium. Premium I collected was $50. So now I'm going to sell it for, I'm going to buy it back if the price goes up to $100. Okay. I don't want the price to keep going up and up because it gets harder for me to buy it back. So twice the premium, $1. And that's it. I put the order and it's an automatic exit strategy. I don't do anything after that. If the trade goes against me, then I pay $100. I got $50 previously. The net loss is the difference, 100 minus 50. So I'm $50 out of pocket. Why is this a good strategy? Well, because the win rate probability for these option trades are typically 70 to 80%. Okay, so I'm getting a good win rate, but I want to limit any possible scenarios where I'm losing money. I want to limit that loss. That is the trader's mentality, not a gambler's mentality. That's it. Today, I showed you how a trader versus gambler have different mindsets. You want to get away from a gambler mindset, always plan for the worst case scenario. And the worst case scenario for options trading is very simple. The strategy is very simple. Twice your premium that you collect, that's your stop loss. I hope today's video was helpful. If you found it helpful, go ahead and subscribe and you'll see a lot more finance nuggets in future videos. Thank you for watching and I will see you in the next one.